All right, what's up, everybody? It's another week, another Ask Me Anything happy hour where we get together as a team to answer your questions. So hopefully you've got questions because we've got answers. Or if you don't have questions, well, we'll just ask ourselves the same questions we always do. Just kidding. Get your questions ready. We'll be right back after this. Back at it. Another week, another Ask Me Anything happy hour. We're going to go around the block. We got a light showing today. Looks like everybody's busy. But my question of the day is, how much wood could a woodchuck chuck if a woodchuck could chuck wood? Anyway, let's start with that and we'll go around. Brian, let's tell everybody a little bit about yourself and start there.
By the way, it's one core today. So there you go.
All right.
Hey, everybody, Brian Foucher up in North Idaho. And one question I've been getting quite a bit recently on calls is, how long have you been doing this, Brian? How long have you known about infinite banking? So I did my first policy in 2013. I am not going to say that it was a good policy because it was not, because I didn't set it up. But that was my first intro to infinite banking was 2013. So, man, it's been 12, 13 years almost. It's been a long time. But yeah, so it's been a long journey, but I've been learning about this for a long time. Had a mentor that was actually one of the Robert Kiyosaki's advisors, was my original mentor. So I've been doing this for quite some time, but there we go. So that's what I do. I've been doing. Steven, over to you, buddy.
Hey, what's up, everyone? Thanks for being here. Looking forward to, answering whatever questions we had. We've had some good shows lately on Wealth Webinar earlier, all about the history of IBC and different people that have used it throughout history and just the power of whole life when it's used with its living benefits and applied today. We have a big 2-day training coming up starting Friday morning at 10 a.m. this week, September 12th and 13th, where we're going to dive in and teach everything you'll really need to know about infinite banking, becoming your own bank, and just real world application, what to do right now, immediately. No upsells, no coaching or selling, anything like that. Just a purely educational event Friday and Saturday. And really looking forward to that. It's the first time we've brought on some of our money mentors, people like HELOC Joe and Brian and Linus and Tess, and they're going to be teaching and instructing and then working with you all after the event, which is really, really cool to see. So just been prepping a lot for that and ready to rock and roll Friday morning. But I'll send it down. Shauna's got her mind blown right now, but what's up, Shauna?
I know, I'm doing okay. Yeah, just I'm Shauna. I'm working with Chris and Joe, and I just paid my, I think, 6th annual policy. So I've had a policy for 6 years now. And I'm up to 3 between me, my daughter, and a second one for myself. So just, using it. I'm not an agent, but I'm here to read the questions today, and I'm a user and consumer just like everybody else. So I'll pass it over to Linus.
Very good. We appreciate you, Shauna. This is Linus Nolt here from Hopkinsville, Kentucky. I've been around the campfire for 5 years. My oldest policies are 4 years old at this point. And so, we use it quite a bit in our financial life, always looking to take over more of the banking functions in our life. It's kind of a progression. It's a lifestyle. It's an ongoing thing. Kind of feels like a never-ending thing. It's always a growing process. But today, definitely staying busy, helping more people taking back that banking function by getting new policies. Right now, kind of feeling sick to the stomach, having seen and heard about Charlie Kirk getting shot there out there in Utah. But that's what's on my mind.
Same here.
Yeah. What's up, Joe?
I'm Joe. I'm up here with Shauna and Chris, and utilize infinite banking and HELOCs and leverage and arbitrage, and we're here to answer all your questions. So get them in so we can get some answers to them. Let's go down to Tess.
Hey, I'm Tess. I'm from Michigan, and insurance has been my life for over 30 years. About a year ago, I moved to this side, and grateful to be here. Now it's over to Jason.
We got this. Tess. Thank you for the introduction. Hello, everybody from sunny Florida. It is chilly in the cold plunge, but warm outside. I'm grateful to be here. Excited as always to answer your questions. We're streaming live, so let's get this party started. Let's have some fun.
Yeah, no questions just yet. So
I like Matt's.
was asked earlier.
Well, yeah, get your questions in the chat box. But I like Matt's comment about the banks have billions in policies, but they hide it and ram the CDs down your throat. And why is that? It's all about control. They have billions in life insurance because they control your money. There you go.
Well, if we have no questions, Shauna, you were talking about going into year 6. I have 3 policies too, and I will go into year 6, October 12th.
Nice.
That's awesome. Past the efficiency point for sure. Now it's just flowing through and coming out tax-free. How does that feel, ladies? That's got to feel good.
I want more.
That's it. That's what everyone says, right? I wish I would have known this. Back when. That's what I hear all the time. I've heard it 4 times this week on like 5 or 6 calls. So
I really think we as a nation could start to heal. If we didn't have the financial handcuffs, we could all pursue the things that are really in our heart.
that is the mission. I mean, that is the mission, right, Tess? How do we, because life is not all about just money, but if you don't have money, then you're usually stressed, worried. You're feeling under pressure, especially if you're the provider. Like, why isn't this working? I go to work. I prescribe to the hustle culture. I keep doing more. I get a side hustle, and I'm still broke. Why is that? Well, because maybe you don't know the rules of the game, and until you do, well, it's pretty hard to win. Some people get lucky and they might win, but if you don't know the rules of the game, good luck. I see Chris nodding. I know he subscribed.
Linus and I got a family, the first one officially funded today, and her comment has been, why doesn't everybody know about this? And we're like, help us share.
I was so happy for you and Linus. He shared that earlier. I was like, that's incredible. What a dynamic duo, the two of you working with a family. So
it's exciting.
I have a question that came up on one of my clients that I'll put out to the group here for everybody as well. They asked, hey, if the Feds lower rates, is that going to lower the interest rates on the policy loans? Are they tied together at all?
Not necessarily. If the Fed lowers rates, it'll probably have an inverse effect on the yields, the short-term yields on treasuries and things of that nature, which could impact the aggregate bond index, which somewhat ties to the loan interest rate, but it's not tied to prime. So insurance companies typically don't follow bank rate. Okay, so if the Fed drops rates, the banks are already building it in. I mean, you want to know what the Fed's decision is going to be, just look at mortgage rates. So mortgage rates are already building in a rate decrease. So you can kind of know that's going to come. You're going to see major impact in high yield savings accounts will instantly go down. I'm surprised some of them haven't already gone down because they usually build that in and kind of get ahead of that. You'll definitely see it in, things like loans, car loans and all that will go down, but you won't see that with the loan interest rate on the policies. You probably won't see any impact on that, at least not anytime soon. I would say 2026, you could maybe see rates come down a little on insurance companies, and some insurance companies barely raise their rates. So you're not going to see any movement there. The ones that did have big increases in their loan rates, they're already on the move down. Companies like Lafayette, I know they're playing around with different like tiers of loan interest rates, which I think is a great idea. And you might see that sooner than later.
The response I gave back to the client was similar to that when I said, if you do see any impact from the Fed lowering, it's going to take some time because insurance companies move a lot slower than other financial institutions because they think so long term. But the other thing is they have a portfolio. They have an overall portfolio that's getting a return. So your rate actually could be tied to the portfolio return they're getting because it's part of their overall portfolio. Your loans are. So if the portfolio is doing good, and your actual loan rate could potentially even go up because that corresponds to that return because it's part of the portfolio. So that's kind of
what
what
the dividend side to what you're saying. I mean, the way that they're investing money, the insurance companies right now is very favorable. They're locking in high yields for longer periods of time, which will give a nice little tailwind. So you'll probably see dividends continue on the upward trend before they start kind of leveling off a little bit. I would expect that, but I just don't know how much movement you're going to see in interest rates coming down, except for with one carrier. You'll definitely see that, but yeah, I don't know.
I mean, the ones supporting IBC, they're trying to keep it like at a competitive level, right? That's what I've seen across the carriers we work with. And Chris, was it tied to that? I remember you teaching or someone saying it was tied to the LIBOR index or something.
Yeah, LIBOR bond index is one of the main things they tie it to. Some of them will look at many different, indexes to kind of base what the rate is, but that's the biggest one they use.
All right, we did get a couple questions in here. So Robert saying, hi, everyone. How much money on average should I set aside each month for getting professional help? For example, real estate attorney, CPA, trust attorney, etc. And then the second part is saying, I live in San Diego. Can I use the same people your team uses? And if yes, would you please provide their contact info? So I'll bring up the first question.
I mean, I don't know. That's a hard one. I mean, it depends on your level of investments. It depends on your revenue. It depends on a lot of factors right there.
Depends on what you're trying to accomplish too. That's the first thing I thought of. Like, what is the reason that you need to talk to the attorney or the CPA? Like, what are you trying to set up? Are you setting up trust? Like you mentioned, a trust attorney. There's a lot of variables. Maybe Chris has a generic answer for this, but I wouldn't know unless we had more details and knew what you wanted.
Pretty broad question.
And then saying, since they're familiar with the IBC process. So I think the idea here is employing or grabbing a team of people like a CPA, a trust attorney, and maybe even a real estate attorney that is going to help use IBC money.
So how I used to do this, the CPA is just a constant. So that's a flat fee I do per month or bookkeeping or whatever it is. The trust attorney is typically a one-time thing because you set up the trust and then you're done. But the real estate and the attorney thing, what I would do is I had that built into my projects. So if I was doing a flip or something like that, I had it built into my cost because I would go to the attorney and have them do the contracts, and I'd go to the attorney for the legal documents. So it was a fee I had per project. But once again, it depends on what you're doing. So that's how I've done it.
I mean, I certainly know a really good CPA in California, but you wouldn't want to use my CPA because my CPA is from California. My tax attorney is from California. Just happens to be that's where they live. But you wouldn't want to use my CPA unless you were looking for like a pretty high level CPA because he's expensive. Number one, he's very good and he's selective on who he'll take on because if you can't help you with what he's doing, then he's not going to take you on. In terms of real estate, we know a bunch of California real estate people. Attorneys, just hold tight on that, Robert. With the attorneys, we're building out the legal corner inside privatemoneyclub.com. So in a couple months, we'll probably have a bunch of attorneys, especially from places like California, the bigger states, that will, sign up on there. And then you could just go to privatemoneyclub.com, go to the legal corner and, kind of just start interviewing attorneys. That's probably the best way. Trust attorney, I would say Corporate Capital is pretty good with trust. We haven't had any issues with them on the trust side, so they might be a good starting place. But again, I don't know if you need to so much worry that all these people live in California. Like I live in New York and my CPA is in California. So maybe broaden that horizon a little bit, and I think it'll be easier for you to find the right person.
It's like us, right, Chris? I mean, we live everywhere. And, you guys are working with us because we are, in our minds, we are the best at what we do and serving you and solving your problems and doing it the right way. And we live all over the country. So it doesn't matter if we're in your backyard.
We definitely have a trusted network of people, that we've been using for years on that. It's just, your question's broad. It's like, real estate, attorney, CPA, trust attorney. It's just like, if we get a little bit more niched down, Robert, on specifically what you want. And then even on like the CPA and the attorney side, like you can't just say CPA, like what do you want your CPA to do? You just want a CPA to push tax returns for you at the end of the year? That's easy. You want a CPA that's going to do tax planning for you 12 months of the year or quarterly, or, like you gotta define what you're asking for. The question always drives the answer and you want the best answer. So you got to refine the question.
Who's running a vacuum?
Yeah. That's weird.
That was weird.
That's weird.
Now, if you hear a cat, it's mine.
Not me once, which is unusual. So.
All right. What do we got next? Shauna looks distraught. I think we all are.
Yeah. I guess Donald Trump just posted that he died.
Yep.
Yep. I see it. It wasn't looking promising. I mean, the shot he took to the neck, it wasn't good. Sad day.
Yeah.
Sad state of this country, I'll tell you that. It's actually sad state of the world right now.
Yeah.
I mean, what's going on in Nepal and, it's just sick. Anyway, let's try to get back to the questions.
Brent Burdick is saying, hey guys, let me know if you need my help with Money Tank Regional Chicago.
Do we have a Chicago Money Tank in the works? Steven?
Yeah, the local with Tish and Brett.
Yes.
Yeah, I'll connect you with Bob. Bob's working on that.
Yeah, and Brent and Tish should definitely get together on that.
Hey, you're only 4 hours away. I'll come visit.
So Jake's saying, do you guys know anyone that works with USAA? I have a convertible term with them about ready to convert part of to whole life with cash value.
Who did I know? I did know an agent with USAA. Shauna, who would know that was Jason. It was somebody Jason knew. I'm not familiar with USAA, as to whether or not they have a whole life that would technically work for this, but hang tight, Jake, and let me just do some research on USAA's whole life and see if that's even a possibility.
Yeah, see if they even allow it.
Okay, and then J10 is saying, if having a loan outstanding for approximately 6 months and have additional capital, should I repay the loan or add to the PUA, have room in the PUA rider to deposit?
We love this question. This is such a good question, Jay. It always, right? The 2 words, Joe. What are the 2 words? It depends. No, 2 words, Joe. It depends. Jay, I think adding to the PUA may make more sense because that's going to give you high cash value. It's going to expand the legacy piece, and it's going to increase the likelihood, of your dividends paying out even a little better, because it gives more, fuel to your system. And at the same time, maybe you just take the time to look at the spread of how much are you recapturing, like what is your actual policy loan when you repay it. Like how much is that bringing that balance down from whatever the going rate is to what the actual percentage paid. So it's a little bit of a balance of what you're trying to do, but I like the move of putting more PUAs in when you can.
Me too.
I would echo that. I think typically PUA funding takes a higher priority than policy loan repayment, but it definitely depends on the entire picture in what your cash flow is looking like now and what it's maybe going to change in the next year or two and all that.
Dinner.
Somebody just say dinner?
Yeah, dinner.
I'm hungry. Let's go. What are we having? Patty says it's not her. She's not ready to feed anybody. Not yet.
Okay. Maiden Blue is saying, I have a random question. Do y'all have any wisdom to share on which bank or credit unions to use for a business account?
I think
Guys aren't usually good with business accounts. We're having issues, right? We have a credit union that we use for some business stuff, and we're doing a loan right now for this building with a credit union. It's been rough. That you can tell they don't really do enough of it to be good at it. So I don't know. Do you have anything else, Brian?
I mean, if you're doing just general transactions and not doing like big loans and things, I like to go to a local credit union and find their bank or their guy that represents businesses and build a relationship, because that'll give you a bit more access and more flexibility. Someone you can talk to if you have like issues, or hey, I need a loan or something like that, or a credit card. You have that person you can call. I've had them with small business or small banks and like large ones. The large ones suck. I don't recommend them, like Wells Fargo and Chase. They're just, you're going to sit on the phone all the time. So I like to have that local person I can go to. When I've done the SBA financing, it's a crapshoot, and stay away from SBA financing anyways.
Yeah, I would echo a lot of that. I've had terrible experiences with big banks. It's like it takes an entire big playbook, somebody that's already know kind of all the internal rules with the big banks to really have a lot of success with them when it comes to financing. But business checking accounts, I prefer going to small local banks that have a strong bottom line, or credit unions, either one, and find one that's like the local real estate investors already know and like. Especially if you find one, because there are still some out there that don't charge a monthly maintenance fee on accounts. I think that's often a good sign, but those are few and far between nowadays.
Yeah.
And then no other questions right now that I see.
So I'll pose a question to the group that I got here. Well, I've gotten a few times. So I had someone looking at the tabular detail. So that for everybody, that's the page that shows the forecast of the cash value and death benefit year over year. And they were trying to look at how the cash value went up in the years, but they're saying if the dividend rate is 6% or whatever, it looks like it's going up by like 8%. They're having a very hard time seeing the numbers, and they're trying to understand like, it's going up by more than what it seems like it should be. And this is Lafayette, by the way. Anybody want to venture a response to that kind of a question?
You can't, I can just tell you, you can't really use straight math to figure out what's going on in there, because everything is baked in together when it comes to cost of death benefit, expenses in the company, and what's left over in cash value for you, basically, and the growth thereof each year from dividends. There's no straight number or math that you can use to calculate it. There's a whole lot that goes into that. That's my take.
Yeah, it's a hard one to explain sometimes, because people that are very detailed in numbers really want to get into it, and they're saying, okay, if I take 90% of all the PUAs and the dividend is a PUA and 90% of that, it's going up by more than that. And they're right, it does sometimes, because it's not an exact 90% either, by the way. When we say 90% of PUAs, it's not always 90%. It could be 91%, it could be 89%, it could be 92%. It can kind of fluctuate.
Yeah, and your base generates cash value after
you're
your 3 years. Yeah.
Yeah, like the larger your base, the larger your dividend's going to be, the larger, so there's like a lot of variables. I'm sure your age plays a factor into it because of the cost of the death benefit. There's a lot of variables, and my experience with folks like that, Fouts, when they want to get that detailed, I know you're really good at navigating these conversations, but it's usually based in fear, right? Which, like it's usually based in some kind of worry, like, hey, I've got to math this out to prove to me that this is actually what it's supposed to be, and it works this way. And if I can't figure it out, I won't do it. Like I had a guy who could have protected his business completely, left a legacy for his family, like everything he told me he wanted, we figured out. And then when he couldn't do the math that you're talking about, he's like, I'm out. I can't build it on a spreadsheet. I can't do this. But it was really some other worry that I had never been able to get deep enough and uncover with him.
Well, this client, by the way, they actually have gone to 5 different agents and asked questions, and these same kind of questions. And of course, as usually is the case, they're moving forward with us because we were able to answer the questions correctly, or the better understanding they have now. So, they're an investor, and so they know that this is not an investment. But we're trying to understand, how it's put together, trying to understand cost, cost of money, growth of money, all that kind of stuff. And they got the questions answered from what I said, but it's as you said, it's not a simple percentage and way to map it out. And so what I do with those individuals is I say, well, you can focus on that, but I'd rather focus on the break-even points, the cash on cash positive, when the policy becomes very efficient, because that is what it's going to be. And then we'll put it into a spreadsheet and then show them the actual cash on cash returns, and that usually gets them beyond that. But it is a interesting, analysis.
And to that, Brian, like the conversation I had a little earlier today was with a real estate investor who had gone to someone else, and they designed a policy that was fine. Like it was your typical 60-40 Nelson Nash model. And, he's just like, I've been staring at this thing for hours and I just don't get it. Like, I believe that this is the way to go, but like, it doesn't even hit like he called it wasn't a break even, but the year I put in X amount, 25 grand, and I have more than 25 grand tax free to use was year 9. And I was like, well, if you're trying, like, what's happening there is like, you basically went to the doctor and like, I don't feel good. Oh, well, here, take this drug. Go ahead, just take this. It's going to be fine. Like, this will probably knock out 90% of whatever you need, because I don't have any more time to really sit here and think about what you really want to solve. So I'm just going to prescribe something so you go away. And that is kind of a lot of what our business is. It's like, hey, I went to 5 people because I wanted to see 5 different illustrations and have someone that can answer my questions. And all I really want is, hey, man, can you solve my problem? And you got to spend the time to ask the questions, which you do, Brian, we all do, and really understand, like, what's the problem today and how do we tie it to the long-term vision and map out the whole thing. That way, you know, as long as you take the right action steps and do what you say you're going to do, you're going to be successful.
Yeah.
You know, like you're prescribing, you're basically malpracticing when you're doing it the way that the other people did it prior to you. So,
and a big part of that is that when you're talking to another agent, it doesn't matter if it's us or anybody else, they got to be able to answer your questions to your satisfaction, not ours. And I have a current client right now, actually I'm looking at his stuff right now. He has an IUL. And the agent set him up with the whole thing, and then the agent couldn't answer very many questions. This is an old IUL, by the way. Couldn't answer the questions, can't answer them today. And now the IUL is actually, I think he's put in $42,000 over 15 years, and it's only worth $40,000 in cash value.
Phew.
Yeah, and so he is not very happy, of course. And he's like, but what are the next options? And so I went through, answered the questions. He's like, okay, now I understand what's going on. I understand how this should have been done. He understands a lot more. So now he's got better options. He unfortunately kind of lost those years of growth that he should have had. So, yeah.
And that's probably 9 of every 10 policies being sold out there. And then the one thing that came up the other day, speaking in IULs, and I know, thank God Vivi's so cute and she's here, because otherwise Chris would be just, you know, lighting this up, going this way. But I was watching Chris Kirkpatrick talk about like kind of debating an IUL. The guy sells IUL and whole life, and was debating this guy on Caleb's site, right? And I was just watching him go through the IUL illustration. I'm like, how many pages is that? Like an IUL illustration was like 76 pages because there's so many disclosures, there's so many moving parts, there's so many things happening. Like I honestly couldn't even understand all of the things that are in that. Like it would take forever to go through and understand everything that they're disclosing and trying to make you aware of. How do you expect to win that game when you have 76 pages just to look at the numbers that you're putting into it? Yeah. That's nuts.
That's the whole thing. And when you think of an IUL, I mean, the contract is so complicated and just convoluted. You really can't understand it. You don't know what you're buying. So you're literally relying on the agent who's selling it to you, and that agent is selling it to you because it's the highest commission product. I mean, I'm not saying that's always. I for the first time in this entire career, I did have a client send me a policy that was designed. Sorry, guys, policy that was designed, and yeah, thank you, Viv. Just keep it in one place. Shoot.
Viv, you're doing awesome.
Adorable.
You're the star of the show.
Okay, we're going to put this back over here. But it's the first IUL policy I've ever seen that was actually good. It was, but it was run with a hypothetical rate of 4%. And it was high cash value. The surrender versus the cash value amounts were in line. So this agent really knew what she was doing. And, you know, I even told the guy, I said, this is the first and only one I've ever seen that was done correctly. I mean, normally they're just selling it on a false pretense that they're going to receive this hypothetical return and it's going to be consistent. And that's just not how it works. It does not work that way. Like it will single-handedly, I have a feeling that IULs will be single-handedly one of the biggest hits to the life insurance industry ever in history because of the sheer amount of these things that are being sold and sold completely improperly. It's all going to blow up. You just wait. We just haven't seen a market downside. We haven't had a market downturn in a long time. Well, everything that's going on that you're seeing in the world right now, believe me, it's coming. It's and we'll be lucky if that's all we get is a recession at this point.
Yeah. Hey, Shauna, there was Lucy had a question earlier on. I put it in the stars section.
Lucy.
Or sorry, Lynn. Sorry, Lynn.
Okay.
The L's.
Yeah, so Lynn is saying, is there a way to work out the cost of premiums?
Now, Lynn, I'm trying to understand what you mean by cost of premiums. So
I think she's just asking, like, can she pick and choose how much her premium deposits are, which is kind of just, that's all we know, because that's how every policy is designed based on what the client wishes to put into the policy. But remember, you got to remember, like a lot of people are used to regular life insurance where the agent tells them how much it's going to cost, where we're asking, how much would you like to deposit? Because we're building banking systems. We're not selling life insurance. I mean, life insurance is part of the whole process. So effectively, I guess we're selling life insurance, but we're doing it for a completely different reason. So I think that's what she means, but she can clarify the question.
Lynn's premiums are $420 per month, FYI.
420, huh?
Yeah, there you go. So Lynn, I mean, you have a policy. The premium is $420 per month. So are you referring to that policy premium or something different? I'm not quite sure.
Or is she trying to understand the difference between like the cost of insurance versus the PUA?
Potentially, yeah.
Yeah, maybe Double L will give us some more clarification. I know one of the things we talk about all the time is one of the big differences between a regular whole life, like off the shelf, like say you bought up a whole life policy, I mean, $420 a month times 12, so $4,800. So it's $4,800 a year, right? In that policy, it's all going towards the cost of insurance, right? So it's going to take maybe 5 to 7 years to generate any kind of cash value versus the way we're designing it. We're going to make it have I like to say, a manageable floor and a meaningful ceiling. The manageable floor is for the question that everyone asks, Jason, what happens in year 3 when I just stop working or I can't work anymore or something happens? Like, how do I make sure and say, well, hey, look, if you're doing this annually, well, you can go down to monthly and it's down to this lower number. That's 30, 40% or whatever it is that we put towards the base based on what you're trying to do. But your meaningful ceiling, this distance between here is what is accelerating your banking. It is what you're going to use for all your financing needs, your investment needs, for the things that you're going to purchase in your life with the banking process.
Kind of on that same topic, or that goes a little bit to expand in a different way. Is Deborah's asking, can I open a whole life with 50 to 100,000 with no monthly premium, but use it as IBC when needed? Almost not wanting to subscribe to premium deposits, and like that's how I'm interpreting it. And then which insurance companies will structure the policy for IBC in North Alabama?
You can. It's just taxable.
Well, yeah. I mean, Deborah, I mean, if you could definitely start a policy with that, you definitely can use it whenever you need. It's an opportunity fund, right? So if you're going to store your money, like we get a lot of the questions, well, hey, I have my, like Brian for Take Back Control Tuesday. Hey, I have my money in a high yield account and, I'm getting paid 3.5 or 4% or 4.2%. And it's like, great. That's awesome. You should do that. And that money is all taxable. Well, what if you had it in a policy and you're getting 3.25% guaranteed and you're likely to get a dividend every year? So now you're earning more on that same dollar while you're storing it for whatever you're going to use. So that would be an annual premium deposit. Now, the part you'd have to work out by having a conversation with one of us is, well, what does that look like in year 2, 3, 4, 5, 6, 7, 8, 9, 10? Because you can do another annual deposit. Or otherwise, like Brian said, you're going to have a MEC policy if you're trying to do a one-time premium deposit, which means it's a modified endowment contract. There are benefits to it, but it's not what you're looking to do. And as far as the companies, basically any of the companies that we work with, the large mutually owned dividend paying whole life companies that we're contracted with, can help you with that, which we can also help you with that conversation as well.
Because it's kind of, as she starts to understand the process more, you wouldn't want to never put in another premium.
Exactly.
Yeah. It's like Joe asking, hey, in year 10, if I hand you $1 and you hand me $2 back, how many dollars are you going to get? You know how many people just freeze on the call with me? They're like,
Yeah.
Oh, man, you give me $1 and I give you $2. How many dollars are you going to give me? $1? I'm like, oh no.
Yeah, that last question, we get a lot of people asking about the single premium because I think, they're still thinking of the additional monthly premium deposits as payments. But, like those same people, like I can't remember who asked that last question. What was her name?
Deborah.
So like Deborah, like one thing to look at is let's say you did want to put money in a chunk, 50, 100 grand. You dump the 50, 100 grand in, and then you figure out, all right, what's the amount you save now? How much are you saving in regular bank accounts? Like most people have like a set monthly amount they save, and then just take a look at what you're earning in your regular place where that money is that you're saving, and then have us run a scenario where you're putting that plus the dump into the policy, and then just look at the difference in the growth pattern of the two. We've run this math a whole bunch of times, and the question will certainly change when you do that. You'll say, well, how much more can I put in? Because you'll see that growth. So I think a lot of people, like in the beginning, they look at it and they're like, well, I just want to put the money in once, and I don't want to have a payment. But it's because we're not going to set it up as a payment. We're going to set it up as a premium deposit. So it's money you're saving, and all that money can be available to you every time you put it in, just like you do your bank, but it grows tax-free, gives you the death benefit protected. It's just, you just got to maybe just see it. My daughter is all over the place.
As she should be, which is awesome.
Yeah,
Look at that
adorable.
first law of wealth, right? Deborah, if you think the one that
I watched Linus's two girls for almost an entire training the other day just sit there and just have their arms on his shoulder. Like, where's that?
Just wait, there'll be 4 on his shoulders real soon.
Yeah, it's amazing. And I have the pictures of them right here next to me. So the pretty girls.
Beautiful.
What I was going to say is, like, think about if you look at what the 1% have been saving on average since 1910, like, would you be shocked to know that was 38% on average? Our savings rate in the United States since 1985 has been consistently less than 5%. And the only time we really saw a spike is when we printed money during the pandemic, when they just gave bunch of stimulus checks, and you saw it go up into the 20s, right? But so if you look at the first law of wealth being pay yourself first and at least 10%, well, where are you going to store that money, right? Where are you going to put it? Somewhere where it builds as an opportunity fund. You're storing it. You're being proactive in your life, Deborah. And that gives you all of the opportunities that you actually want. You just don't know it yet, because you're so used to the traditional way of doing things, which is cool. So you're here asking the questions. Now it's just, continue that training, that learning, and that'll unlock for you at some point. We don't know when, but we know it will.
A major mindset is they're thinking this is life insurance. It's a bill, but not the way that we build it, because it's a banking. And in year 10, if you're putting in 5,000 and being able to take out 10, 12, 15,000, you would say, oh, I definitely want to keep contributing every year.
Yeah. When it's whole life, right, Joe? I tell people all the time, like, hey, if you asked me 5.5 years ago if I'd ever have a life insurance license, I would have let you punch me in the face. That's a joke I've never heard. And now I'm sitting here with all you guys who, we're all licensed everywhere.
So for the next question, Matt Love is saying, hey guys, Charlie Kirk was just murdered, a prominent political voice. In my own words, it's utter bullshit. But he's saying, can you spend some time talking about the value of the death benefit today? This life is a gift. And the number one reason I love this strategy is that it takes care of your family first with a tax-free death benefit. Keep up the good work.
I can certainly speak to this as being someone that's been in this industry over 20 years. I've delivered more death benefits than I think I can remember. And, it's great, the living benefits and all the IBC stuff and the growth. It's like I said in Wealth Webinar today, if someone ever gets on the phone with me or any of you and says, I don't care about the death benefit, like, just disconnect the call. Just say, we're just not aligned ethically. We just don't see things the same, because, you need to care, about what it is you're doing with this more than just how much you're going to make on your money, which isn't going to matter the day that you're on your deathbed. What's going to matter is, is your family going to be okay when you're gone? And that's what the death benefit does. And of all the death claims I've delivered, it was a policy with New York Life when I was there that you had to actually hand deliver them. So we would actually file all the reports, hand deliver the check. And, I can't tell you how many times I delivered checks to widows with their young children, where the husband unexpectedly passed away, a lot of times heart attack and, car accidents. I had one murder. I really don't want to talk about it. I've told some people closely, but that was the freakiest thing I think I've ever happened. I knew I'd met the husband. I was working on doing some stuff with him. And then she called me up frantic, like wanted life insurance right away, was rushing the underwriting. Like, it was kind of weird. Like, she just really wanted it. And I didn't know. I thought she just wanted to get it done. And well, then you can maybe piece the puzzle together. That was a difficult one, but she had 2 young girls, like 2 little girls. And at least I know that those kids were taken care of. And I had another one where he was an older gentleman, one of the first people that really gave me a shot in the investment world. He was an engineer. And I remember as his life kind of started deteriorating, we went from change, the conversations, could I go over there often? His name was Bob. And the conversation was always about growth and investing and everything. And I remember, like, for the last 2 years of his life, like, every conversation was about, is everything all set for her? How much death benefit do I have? How will this work? Where will it transfer? Will there be taxes? Every question under the book. But I mean, that's an engineer for you, right? And then what we did is he literally went extra levels. He didn't just say, hey, that's great, there's going to be this couple $100,000 paid to my wife. He said, I want the couple $100,000 to go into this trust. Then I want to buy a guaranteed life income and then have that income paid to Betty. And that way Betty can support all of her lifestyle and she'll have more money than she'll need, for the rest of her life. And then when Betty goes, that money then would refund to, the family, which there was 3 children. So a lot of thoughts. So it's kind of what Matt's saying is, I know we always talk about IBC. We talk about the growth and the returns and the tax-free, but none of that shit matters. What really matters is when the inevitable happens. And it's not it's going to happen. Charlie, is just an example of, like, someone that it happened to way, 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 way too soon, and just out of all the wrong reasons. But you never know who that could be. I mean, there was that little girl, on the subway. I mean, you hear about it every day. It's just getting worse and worse. So we need to start talking about the death benefit more. We just have to.
Yeah. Thank you, Chris, for that. And Matt, thank you for the question. It's good to see you here, brother. And that is, as a father, I can tell you I actually feel fortunate that I haven't delivered, a death benefit yet to any of my active clients. But I have, I can tell you from being a dad myself and seeing, like, Patty had to fight me to get a term life policy when Connor was born, literally had to argue with me, and it was tough. And now with the whole life policies and having, knowing that my family's taken care of no matter what, and then really putting those systems and processes, how to carry on other things other than just the monetary piece of it. But it gives you that peace of mind as the provider. Like, hey, I know they're going to be taken care of. I know that they'll be able to pick up the pieces when you're not there. So it is something that's on my mind with every single person we're talking to, every person we're helping solve their problems. This is always the cherry on top. That is really probably the most important thing.
Yeah, I can add one thing close to home for me. My father just passed away a little over 3 months ago at the young age of 51 of aggressive cancers. And now he was in a religion similar to Amish where he did not consider life insurance at all. So there was no coverage. And so me being the oldest of 11 children, we're having to work things and figure out strategies on how to support the rest of the family still at home. So it could be very different if I guess in this case, if it wasn't for the religious barrier of that didn't let him consider life insurance when I presented it. But it's very important. It definitely changes the outcomes for the people who stay here and pick up the pieces.
Yeah, Linus, to that. Thank you, Linus, for sharing that. To that point, it's really thinking way beyond yourself and thinking about others when you make sure that everything is taken care of. Because when you're raising kids, when you're raising a family, we're raising adults, and we don't want to leave them with our problems, right? We don't want to leave them with the things that we didn't take care of because we didn't have the foresight to say, hey, let's make sure everything's taken care of. It's a smooth transition for everyone. Let my memory carry on in a way where there's joy and they're provided for, and they're taken care of versus they're stressed, worried. Because I saw it in my family. I saw when my grandparents passed away, I saw things going to probate. I mean, that's not exactly what we're talking about, but the power of really thinking long-term and really starting to plan for the future is being intentional, is talking to your kids about this, is having those conversations with your folks if they're around. It is doing all these things. It's forcing me, in a way, Matt, to go out and have that conversation with my father. Like, what is going to happen when you're no longer here? Like what happens to your big property up in New Hampshire out in the middle of nowhere? Like same with my mother, like starting to have these conversations because they're important. It's important to know what's going to happen. No one wants to talk about death and the death benefit, but guess what? We're all graduating at least most of us. Maybe not Joe. Joe might not be from this planet. I'm not quite sure. But like most of us, you know, are going to graduate at some point. So
yeah, I've heard people call it love insurance rather than life insurance, and I think that's a good description.
There's another question from James saying, as others who are speaking, I have a cash value line of credit at BUC Bank, making life so easy. I'm thinking about moving my personal and business accounts there as well. Thoughts or any reason I shouldn't?
I've thought of this, and the one thing I think would make it really cool is the ease of transferring back and forth to basically practice velocity banking with that cash value line of credit easier. So there's that thought, but I'm not familiar with BUC Bank.
Now, isn't this the bank that Chris said he was having some difficulty with earlier today?
No, they used to loan out small amounts based upon small cash value balances, but now they're limited to minimum $75K to do that.
Yeah, that's right.
So yeah, so you have to have $75K in your policy or policies cash value wise to get them to even do a line of credit now. It sounds like.
Yeah, that makes sense.
Okay. Robert is saying, is the dump-in the same as PUA, and can they be increased once the policy is in force?
It's not the same. A dump-in is just kind of an internal word that means the premiums that you're dumping in to the paid up additions rider. So you're putting your dump-in deposit into the paid up additions rider. Typically I'll let Linus hit on if it can be increased once the policy is in force, because that's kind of a slippery slope.
Yeah. Maybe to clarify, I could say it this way, that the dump-in is PUA premium, but it's a specific type or frequency.
Yeah, it's a rider. It's a rider that's an add-on in addition to whatever your premium deposit is.
And so to do a dump-in after the policy is in force, it's typically not going to be an option unless the policy was designed for that, or basically built with that in mind to allow that. So yeah, that's possible. It's going to be a conversation you want to have before putting the policy in force to make sure that you have some extra room for that, or design it for the same big dump-ins in subsequent years that you did in the first year. So those are options.
Good question. I know a lot of people are wondering that, because there's a lot of confusion for folks, like between paying your premium deposit annually or doing a dump in. Like you always have to clarify, like, are we talking about the same thing? Are you looking to do an annual premium deposit and put additional money in, or because I see everyone nodding, that's a super common, just people lump those words all together. Like a dump in could be a lump sum, like a one time if you're one company. A dump in is an additional rider that's added, and that's usually what's going to really, when you look at some of the older design videos that Chris has out there, the HEC V, the high early cash value, that's how you're getting high early cash value, because what you're doing is you're buying a convertible term, depending on your age and how much, and then you're taking the rest of that and it's going into PUA, and that's usually giving you 80 to 90% of that capital available immediately. So that's when you overfund something, that's how you're getting the higher cash value to put the money to work. And as Joe loves to say, that's when you get the cash tree in year 2, folks, is when you're overfunding those policies and moving that money through. And so it's just about what you have to keep in the policy, right, Joe?
That's right.
You can't take out.
You got it.
Yeah, man.
I
work on my Joe every day. Sometimes I just pretend I'm you for the whole time. I just click, I pop, I talk about what you got to leave in. It's a good time. So
I usually call it the overfunding of the policy. The PUA is the banking portion that you're able to borrow.
Yeah. The amount they didn't spend to write the insurance.
Yeah, the part that we can't touch yet and be left in years 1, 2, and 3. But what happens in years 4, 5, and 6? Now we're able to use all of that, and by years 8 or 9, we're able to take out more than what we even put in. That's
Joe,
your money tree.
It's a beautiful thing.
Joe, do you remember like this is months and months ago on the AMA? We said, yeah, it's basically 2 years of patience for a lifetime of profit. And when you start looking at the vault, you see in year 1, if it's overfunded, you might have that 80 to 90%. Year 2, you're typically 70 to 75%. But by year 3, there might only be like 5% that's unavailable. And you're like, what?
Yeah.
It's really 2 years of patience, folks. So
That's
you're not
it.
tying your money up forever. If it's designed otherwise than that, then it's not really for banking. But you're looking at 2 years where you're going to have access to 60 to 70% of your capital. And then it just starts accelerating from there. Now, the older you are, it might take a little bit longer, right? Like if I'm talking like 55 plus, 60 plus, but it still works for banking. You're still going to hit the efficiency point pretty fast. But that is the only really big difference when we're looking at your patience and the thinking long term. So it's a lot.
That's
We got
why
anything else, Shauna?
that's what we call it our deposit and running it through.
There's a couple of comments here that are starred. So Dexter saying paying interest yearly and adding to PUA could be more of a benefit than paying loan off. That was starred.
It depends.
Yeah.
But yeah.
And then Mark is saying, hey, Chris, have you heard of the Cantillon effect?
When I saw you put that in there, I read it. So it describes how money creation in the economy leads to uneven price increases, benefiting early recipients of new money and disadvantages later recipients who face already inflated prices, which is we're at the end of this cycle. So I didn't ever hear of that, but it's the world we live in.
And then Lawrence,
banks and the last people is always us, right? The ones get to hold the bag.
Yeah. Lauren saying, thank heavens I had a policy on me several years ago issued before my stroke. So that's exactly why we should have this sense of urgency. We do not know what tomorrow holds.
And to that, for anyone who's thinking, hey, I might want to practice this one day, but I'm just not ready. Well, let's talk about having a convertible term for you. Let's lock in your insurability. Like Lauren just said, you just never know. You never know when that day is coming and you're no longer insurable. I've had people who were thinking about this. Actually had one guy who let his policy lapse, ended up having cancer, and now can't get a policy. And so we created policies once he decided like he had to have this on the kids in his family, but it's not as efficient, can't put in as much, and all of those things, all because he didn't think to have a convertible term that he could have for 10 years, 15 years, 18 years, whatever it is, to lock in the insurability while you're healthy. Because health is wealth, period. Yeah. Like there is a point that you probably won't be insurable. So,
and like earlier, it covers the death benefit as well. So even if you're not ready to make that little jump into, or I know it's a big jump into the IBC process, but you're still protecting your family with that death benefit as you learn this process.
And then our final question here from Made in Blue is saying, if you've started trust and legacy aspect, do you have any examples of verbiage you'd be willing to share that protect the policy for future generations?
Yeah, I have that YouTube video.
I was saying, Made in Blue, come to our 2-day. We're talking a little bit about this, how you can create the family constitution, how you can look at basically a 3-step process of, first you want to have your frame, which is your vision, your values. How do you carry that on? The language you're teaching, the processes. How do you fortify it? That's the trust piece, and you might not need as much of the trust as you think to start this process because you can build on it as you go. A lot of people hesitate because they think it's only for the wealthy. They think it's hundreds of thousands of dollars. They think it's complex, and it's really not. You just have to find the right estate planning attorney that understands what you're trying to accomplish. Like Chris said, what are you trying to do? Always. And then the third piece is flourish. This is the piece that you're talking about. How do we carry this on for generations and generations, like the Rockefeller waterfall method? So come on Friday and Saturday. We'll be covering this at points. And like Chris said, he's already got a video on it as well.
Yep.
Yeah, the legacy workbook would be really good for you to read as well. But yeah, that you get that actually with the purchase of that ticket. $47, 2 days, nail it.
I want to talk just a little bit about convertible term, like Jason mentioned. For anybody that's new here or new to that language, that concept, or the industry in general, I guess, is it's a term life insurance policy that's, as you know, term is cheap. It's just slightly more expensive because it has a conversion privilege, allowing you to convert it to a whole life that we can design for infinite banking at any point throughout its term period, typically, unless you're reaching an age threshold, which is 65 or 70, without having to prove insurability, going through underwriting. So if something happens with, say you get a 20-year convertible term, something happens in your health where you're no longer insurable, and you did have a 20-year convertible term, you can now convert it to whole life to have that death benefit for the rest of your life without having to go through health underwriting. And so your health problem at that point won't impact your ability to get a whole life. So that's a very smart, like they were saying, to lock in your insurability.
Thank you, Linus. That's awesome. Just to make it simple, all you're doing is you're getting underwritten now. You're going to pay a much smaller annual or monthly premium, and you can convert that when you're ready, if it makes sense at some time. And if you don't, then you don't. But at least you've protected your family for that period of time. So
I have a question. Let's say that you go out and you get convertible term, $10 million of convertible term. Every year, can you go in and say, I want 1 million?
Yes.
And keep 9 and do another million every year?
yes.
Thank you.
Yeah, you can do a lot. You can do a lot of cool things, Joe. So you're just converting a portion of that convertible term to whole life, and then whatever the cost is at your age, based on what your insurability level that you locked in was.
Yep.
So that's how that's underwritten. Is that correct, Linus?
I wasn't paying attention. Sorry.
Just say, yep, that was right, Jason. You nailed it. I just said, hey, whatever, like say Joe locks it in now at the ripe old age that he's at, and now
Right.
10 years from now, Joe goes back to convert one of those $10 million, because it's a 20-year term, right, that he has, and he wants it to whole life. Well, the whole life, based on what he's trying to convert, the cost and the design is all going to be based on what gives him $1 million of coverage based on what he's trying to do at age 10 years from now at the rating that he locked in now.
Yeah. That's it.
All right, great. And
That's
I put
those
the
wheels turning. I love it. I haven't seen that happen in a long time.
I put the link in the chat here. It's beyourownbank.com/BYOB-blueprint. It's Friday and Saturday starting at 10 a.m. Eastern. It's $47. It's going to be about 11 hours total, and we will see you there.
Wow. That's a lot of hours.
Great information takes time.
We are ready.
Yep. And there will be recordings as well that you'll be able to get. And, we encourage you to share it with somebody in your life as well.
Thank you, Shauna. Chris, are we ready to take this home? I think we made all the questions.
We are ready. I was just going to post. Sorry, I had that call. I had to post the 2-day event link down below. So grab that. But with that being said, here we go.